Ever wondered how to earn consistent returns in the stock market? Well, you're not alone. This pursuit has been the holy grail of many investors, from seasoned professionals to those just getting their feet wet. But is it all just a roll of the dice, or is there a method to the madness? The truth is, earning consistent returns is less about luck and more about discipline, strategy, and a deep understanding of the market dynamics. It's about having a clear vision of your financial goals, understanding your risk tolerance, and crafting an investment plan that aligns with these elements. In this video, we'll walk you through a step-by-step guide on how to navigate the exciting yet often turbulent waters of the stock market. From diversifying your portfolio to avoiding emotional decisions, we'll explore the key strategies to help you on your journey to consistent returns. So buckle up and let's dive into the steps to earning consistent returns in the stock market. The first step is to develop a sound investment strategy. Picture yourself as the captain of a ship. You wouldn't set sail without a clear destination and a planned route, would you? Similarly, in the financial ocean, your investment goals are your destination and your strategy is the route. Your goals could be anything from buying a house, paying for education, or securing a comfortable retirement. Once you've identified your goals, it's crucial to understand your risk tolerance. Are you a risk taker, ready to ride the stormy market waves for potentially higher returns? Or are you more conservative, preferring a smoother journey? Your answers will shape your investment plan. Lastly, consider your investment horizon. The longer you can leave your money invested, the better your chances of weathering market fluctuations. These three elements, clear goals, risk tolerance, and investment horizon, contribute to a well-defined investment plan. A well-defined investment plan sets the stage for potential success in the stock market. Next up, diversification. Ever heard the saying, "Don't put all your eggs in one basket"? Well, this wisdom rings particularly true in the world of investing. Diversification is the act of spreading your investments across various asset classes such as stocks, bonds, and maybe even some real estate. Think of it as a buffet, a little bit of this, a touch of that. It's not about focusing on one delicious dish, but enjoying the whole spread. This strategy is key in minimizing risk. Should one sector or asset stumble, your entire portfolio won't tumble with it. You've got your other investments to cushion the fall. It's like having multiple parachutes, just in case one doesn't open. This way, you're not putting your financial future entirely in the hands of one sector or company. So, remember, diversification is your friend. Diversification can act as a safety net against market volatility. Invest for the long haul and focus on quality. That's a mantra that every investor should have etched in their minds. Now, let's break it down. When we talk about long-term investment, we're encouraging a perspective that looks beyond the daily ups and downs of the market. Imagine you're on a roller coaster. It's thrilling, right? But if you're constantly worried about every dip and turn, you're not going to enjoy the ride. Similarly, the stock market is a journey with inevitable highs and lows. But remember, the overall trend of the market has historically been upwards. So, if you're investing for the long haul, these short-term fluctuations shouldn't deter you. Now, avoiding market timing is crucial. You see, it's quite tempting to think you can outsmart everyone else, buying low and selling high consistently. But even the most seasoned traders struggle with this. It's like trying to catch a falling knife or predicting the next lottery numbers. It's risky and often ends in disappointment. Instead, focus on quality. And by quality, we're referring to companies that boast a solid track record of earnings growth and a strong competitive advantage. Imagine you're in a bookstore. There are countless books to choose from, but wouldn't you rather pick a bestseller written by a renowned author over a random book by an unknown writer? The same logic applies here. Companies with a strong track record and competitive advantage are like those bestsellers. They're reliable, have proven their worth, and are likely to weather financial storms better than others. But remember, quality doesn't necessarily mean the biggest names or the most popular industries. It's about the inherent value a company offers, its financial health, and its potential for growth. So don't just follow the crowd. Do your homework. And finally, patience. Investing is not a get-rich-quick scheme. It's a marathon, not a sprint. It takes time for investments to mature and for the magic of compounding to work its wonders. To wrap up, quality investments and patience can lead to consistent returns. So, buckle up, enjoy the ride, and let time and quality be your co-pilots on this investment journey. Knowledge is power, and emotions are not your friend in the stock market. When it comes to investing, these words couldn't be more true. Staying informed about market news, global events, and company performance is crucial for making sound investment decisions. It's not about predicting the future, but rather understanding the present. By keeping a finger on the pulse of the market, you can spot trends, anticipate changes, and make decisions that align with your investment strategy. Let's paint a picture. Imagine you've invested in a tech company. Suddenly, news breaks out about a groundbreaking innovation in their field. If you're not in the loop, you might miss out on this opportunity to adjust your position. Staying informed helps you react appropriately to such changes, and not just react, but act decisively and strategically. Now let's talk about emotions. The stock market is a roller coaster, and it's easy to get swept up in the highs and lows. Fear and greed can cloud our judgment, leading us to make impulsive decisions. You might be tempted to sell off your stocks during a market downturn out of fear, or pile more into a soaring stock out of greed. But remember, the market is cyclical. What goes up must come down, and vice versa. Sticking to your investment plan is key here. This plan is your roadmap. It's based on your investment goals, risk tolerance, and investment horizon, not on the emotions of the moment. By following this plan, you can navigate through the market's ups and downs with a steady hand. But what if you're feeling unsure or overwhelmed? That's completely normal, especially for beginner traders. In such cases, don't hesitate to seek professional advice. Financial advisors, for instance, can provide valuable insights and guidance to help you stay on track. In conclusion, staying informed and controlling your emotions are key components in earning consistent returns in the stock market. By keeping up to date with market news and sticking to your investment plan, you can make more informed decisions and avoid falling into emotional traps. Informed decisions and emotional control are vital in the pursuit of consistent returns. Scene script, regular reviews, and thorough research are crucial. So you've got an investment strategy in place, and you're diversified across different asset classes. Excellent. But the work doesn't stop there. Just like a car needs regular tune-ups, your investment portfolio needs consistent reviews. This is not just to track your investment performance, but also to adjust and realign your portfolio with your long-term goals. Think of your portfolio as a garden. Your investments are the seeds you've planted. Now, you wouldn't just throw some seeds in the ground and forget about them, would you? Of course not. You'd water them, weed around them, and maybe even talk to them if you're feeling particularly chatty. In the same way, you need to nurture your investments. Regular portfolio reviews allow you to do just that. They give you the opportunity to weed out underperforming stocks, water the ones showing potential, and realign your portfolio to your evolving financial goals. Remember, the key is not to react impulsively to market fluctuations, but to make informed decisions based on your long-term objectives. Now, let's talk about thorough research. Sure, you could pick stocks based on your friend's hot tips, or maybe because you really like the CEO's haircut. But if you want to build a solid portfolio, you need to dig a little deeper. Research is not just about reading financial statements, although that's certainly part of it. It's about understanding the company's business model, its competitive advantage, and the industry it operates in. It's about analyzing market trends and economic indicators. And yes, it's about looking at numbers, lots of numbers. But don't worry, you don't need to be a math whiz to do this. There are plenty of resources out there to help you make sense of it all. In conclusion, regular portfolio reviews and diligent research are not just optional extras in your investment journey. They are essential tools in your arsenal. So roll up your sleeves, dive into those spreadsheets, and keep your investment plan on track. Remember, the stock market isn't a game of chance. It's a game of strategy, patience, and discipline. Regular portfolio reviews and diligent research can keep your investment plan on track. Finally, consider professional advice and stay disciplined. Navigating the complexities of the stock market can feel like a daunting task. especially if you're at the beginning of your trading journey. This is where the guidance of a seasoned financial advisor or investment manager can prove invaluable. They can provide you with insights, help you avoid common pitfalls, and tailor an investment strategy that suits your specific needs and goals. Now, let's talk about discipline, a vital ingredient in the recipe for trading success. The stock market is often a roller coaster of highs and lows, and it's all too easy to get swept up in the moment. But remember, impulsive decisions often lead to regret. Stick to your investment plan, remain patient, and don't let the market's ups and downs dictate your actions. With discipline, patience, and the right strategy, earning consistent returns in the stock market is achievable.